that was May 2019, that is Advanced Financial Management. Having done question 4, in our today's lesson, we are going to tackle this question 5 is in 2 parts, part A and part B. Part A is a question that tests a candidate's knowledge in capital budgeting decision. Part B is a question from the topic mergers and acquisitions. I will read question 5A first, then I'll answer it here on the board. And as we answer these questions, candidates, I need to remind you that the objective of the Advanced Financial Management paper is to enable you that at the end of these sessions, you should be able to apply advanced financial management techniques in business. That is why you can see some of these questions are practical questions. These are problems that businesses face which call for techniques in advanced financial management. And as an accountant who
producers, welcome. That is 7 Roman A Roman 1, explain the term producer, equilibrium as used in economics. I just want to draw a diagram before I explain that, basically explain that producer equilibrium. We can have this. This is an isocost. That is basically an isocost. So we have capital, and we have labor, and we have labor. This is an isocost. So AB is an isocost line. Then we draw an isoquant, not in difference curve, but isoquant. And then we have Q. We can say Q is 3. So the point that isoquant line forms a tangent with an isoquant, that is where we get the producer equilibrium. So we have equilibrium quantity of capital, that is KE, and equilibrium quantity of labor, that is LE. So we can say that this is 3,000. So we basically need to understand that 3,000 in this particular 3,000 units is the level of output, is the level of output, is basically the level of output, is the level of output that gives that basically gives the firm the maximum. We call it the maximum profit. Gives the firm basically the maximum profit. So what is producer's equilibrium? Refers to the level of output. Basically we say producer equilibrium is therefore the firm, we say the firm's, is therefore the firm's level of output, is the firm's level of output, Producer equilibrium is therefore the firm's level of output, which gives the maximum, what we call the maximum profit, which gives the maximum profit. And as you can see from the diagram, this is an isocost. AB is an isocost line, and then we have Q as an isoquant. So 3,000 is the level of output that will give the maximum profit. So a firm is said to be, just a continuation, a firm is said to be at producer equilibrium at producer equilibrium. A farm is basically to say to be at producer equilibrium, at producer equilibrium, producer equilibrium. If there is no scope, if scope is intention, if there is no scope of increasing, we say scope of increasing, the scope of increasing the profit, or reducing the scope of increasing profit or reducing the loss, the scope of increasing the profit or reducing the loss, or reducing the loss, or reducing the loss by changing, we say by changing the output, by changing the quantity, by changing the quantity of output, by changing the quantity of output, by changing the quantity of the output. So if you look at that question, that's question particularly tackling 2 marks, but it's expounded fully. That is the diagram. So at 3,000, that is where we have producer equilibrium. So 3,000 units is the level of output that gives the maximum profit. But you say producer equilibrium is therefore the farm's level of output which gives the maximum profit, that basically gives the maximum profit. And you say that when a farm is basically at a producer equilibrium, the farm has no scope of either increasing profit or reducing the loss by changing the quantity of output, by changing the quantity of the output. That is how we particularly go through that question. We pick it on the next question, that is question 7, A, Roman B. So the question says, highlight assumptions of the producer surplus. Highlight assumption, that is Roman 2. Highlight the assumptions, what do you call the assumptions of a producer surplus. Highlight the assumptions of a producer surplus. So before we highlight, it is very important to understand what producer surplus. When you talk about a producer surplus, we basically say that there is a difference between the amount the producer is willing to supply good for and the amount that they make the trade, which in most cases we say is an additional benefit, because you realize that what they receive is more than the minimum that they're willing to supply the goods for. So that is actually a benefit. So if you're to draw, that is not of essence, but you can particularly have questions that will tell you to define a producer surplus and draw on highlight 5 assumptions of the producer surplus. When you look at those assumptions, one, we talk about producer is assumed to be rational. Basically, a consumer is aiming to maximize profit, and we know that we maximize profit where MR is equals to MC. So we say number 1, producer. One, we say producer is assumed to be rational, i.e. we say aim to maximize the profit, We know i.e. at the point, MR is equals to MC. That is basically where the consumer basically aims to maximize the profit. The second assumption is that there is perfect competition. There's a perfect competition market. Number 2, we say there is a perfect competitive. There is a perfect competitive. We call it a perfect competitive. There is a perfect competitive perfect competition market. There is a perfect competition market. We know how a perfect competition basically work, and we say that assumed to be perfect, perfectly competitive. Assumed to be perfectly, we say perfectly competitive. Consumer is basically assumed to be perfectly competitive. Then you say that there is free entry and exit. There is, on the next assumption, there is what you call free entry and exit, i.e. there is free entry and exit, i.e. that is to say that producer can freely enter and exit, can freely enter and exit as the third assumption. The fourth assumption, basically, we say there is no externalities. There is no externalities. There is no externalities as the next assumption. Basically, we say that there is no externality. That is saying external cost and benefits, external cost or benefit. No external, what you call external costs and benefits and benefit. No external cost and benefits. And lastly, assumptions, we say constant return to scale. The fifth assumption, we say constant return. We call it constant return to scale. What do you basically mean by constant return to scale? We know that average cost of production remains constant. Average, that is to say average cost of the production, average cost of the production, average cost of the production remains constant, remains constant. Average cost of production basically remains constant as quantity produces increases, as quantity produces, as quantity produces increases, as quantity produces basically increases, as quantity produces basically increases, as the quantity produced basically increases. Again, I said at the beginning of that particular question, I said you can be asked what a producer supply as a major area, and you can also be told to illustrate using a diagram how producer supplies basically come. And that is how we particularly handle that question. That is question 7A, Roman 2. That is how we go about that question. We pick it on the next question, that is question 7, Roman B. With the help of a well-labeled diagram, explain the stages of law of diminishing return. We put that question down. With a 8, we say with a 8, with a 8, we call it with a 8, with the aid of a diagram, with the aid of a diagram, we say explain the stages, of the law of diminishing return, So when you talk about the law of diminishing return, we also call it the law of variable proportion. What does the law of variable proportion basically talks about? We say that when a variable factor of production, that is labor, is added to fixed factor of production, and that is land, we say that total output increases, but at a decreasing rate. The total output increases, but at a decreasing rate. We can illustrate, first of all, come up with the diagram. We proceed to this at the end because this end is a bit small, so we have our diagram on this end. And you talk about those stages. Basically, this law of diminishing return or the law of variable proportion, we have it here. So this is what we call total product at that end. We have the total product. We have this as average product. We have it as average product. Then up here, we have what we call the marginal product. So on this other end, we have total product, marginal product, and average product. And down there, we have quantity. We have the quantity. We illustrate on that point. At that point, we illustrate. So we have what you call stage 1 on this stage 1. We have stage 2, and finally we have stage 3 on this other end. We have stage 1, this is stage 2, and this is stage 3. So basically, when you talk about the law of variable proportion, the diagram is this, and the diagram is basically divided into 3. So we have the first stage, we call it increasing, what you call increasing returns. Increasing returns. So on basically increasing return, we're saying that when a variable factor is added, and the variable factor is labor, is added to a fixed factor production, which is land, total product increase but at a decreasing rate. So what essentially happens in this part is that when that happens, when you talk about TP, we talk about MR, and you talk about AR, are all increasing, are all increasing. All of them are increasing. All of them are basically increasing. That is at increasing return, which is stage 1. Stage 1. Stage 1, as it is. That is stage 1. That is what happens in the stage 1. That TP, MR, and AR are all increasing when a variable factor is added to a fixed factor production, which is land. We have the TP, we have the MR, and AR all increasing. Stage 2, we call it a constant return. So basically we are saying that when we basically had a variable factor, which in this case is labor, to a fixed factor of production, which is land, we will see that at this particular stage, in as much as probably you can have the total product increasing, we'll see the marginal product. At this point, we'll find the marginal product. If you look at the marginal product remaining constant. Marginal product will have the marginal product basically remaining marginal product at a particular point, marginal product remaining constant. So you'll have a marginal product at one point. Maybe you have between quantities, quantity, you can have maybe a quantity that follows, maybe between 4 and 5. You're having a marginal product, which is MP, this is P, average product, and that. This is average product, sorry for that. This is marginal product. So we have the total product in the first stage, marginal product, and AP all increasing. The second stage, we are saying that it's called a constant return, what you call a constant return. So on the constant return, we'll have the TP increasing, but you find at that particular stage, MR remain constant at a particular stage. Maybe a unit of 4 to 5, you find MP, that is the MP, which is the marginal product, remaining constant. So we can have the total product increasing, but you'll find MP remain constant, maybe at 4 and 5. So that is what you call constant return. And then we have the third stage. The third stage, we have what you call decreasing stage. So on the decreasing stage, look at the decreasing stage, which is stage 3. This was stage 2. This was stage 2. This is stage 3. This is basically stage 3. So decreasing stage, we can see the total product, we can see the average product, and we can see the marginal product are all decreasing. In fact, the marginal product is negative. So we see TP, AP, and MP are decreasing. So when we add a variable factor, which is labor, to a fixed factor production, which is land, total product, average product, and marginal product are all decreasing. But we can see also MP becomes negative. Initiating inefficient MP is negative even at that stage. So for the diagram, that question is 6 marks. The diagram will constitute a huge number of marks. If it's 6 marks, the diagram will particularly take a huge mark. The diagram could take even 3 or 4 marks. Then the explanations that we have summarized on this particular point, those who take the remaining marks, which is either 2 or 1, maybe there. But the diagram will basically constitute a lot of the marks in that particular question. The diagram will constitute a lot of marks in that particular question. And that is how we particularly go about that very question. But even on this, we have assumptions of the law of variable proportion, or the law of diminishing returns, the law of variable proportion, or the law of diminishing return. You can have the assumptions. You can be asked the assumption. You can also be asked. On shortcomings or limitations of the law of diminishing return. That is how we particularly handle that specific question. We proceed from the next question. That is question 7, Roman C. Explain 4 monetary policies that the central bank of a country might apply to control inflation. That the central bank of any country might apply to control inflation. So when you look at this particular question on a yearly basis, this is a question that keeps on repeating itself. Even on the 2020, even on the other exams, you find particularly questions that touches on monetary policy is always there. So we put down the question, then we go through the question. So that is to say, explain, one we call explain, 7 Roman C, explain 4, say 4 monetary policies, that a central bank of a country, might apply to control inflation. So I explained 4 monetary policies that a central bank of a country might apply to control inflation. Number 1 is to understand what you call monetary policy. Whenever we talk about monetary policy, we basically call it, these are instruments that are basically used by the government through the central bank to regulate the supply of money. Either the supply of money is high or low. How do you use these instruments to basically control inflation? The first one we talk about is what you call the bank rate. Where the first one we call it the bank rate stroke what you call the interest rate. The bank rate stroke what you call the interest rate. So when you talk about the bank rate stroke the interest rate, we know that when the supply of money is high, the interest rate is usually raised to reduce the money supply altogether, or to reduce inflation, and vice versa. So we say that during inflation stroke high supply of money, interest rates are raised. Hence this will control inflation. Hence this will control inflation. Stroke reduces the supply, high supply of money. So the second one, we can talk about what we call open market operation. Market operation. So when you talk about open market operation, this is buying, what you call buying and selling of the government of the government security. Buying and selling of the government security. And particularly when you talk about the buying and selling of the government security, we're talking about T-bonds and treasury bills and bonds. So we basically know that when there's a high supply of money, that is when there's inflation, the government will basically sell security to the public to reduce the flow of money. So we said during inflation, comma, the government, we say that the government will sell securities to the public in order to reduce inflation stroke high circulation of money. High circulation of money. So we have number 3, what we call compulsory deposit. Deposit stroke reserve requirement. What we call reserve requirement. Compulsory deposit stroke what we call the reserve requirement. Whenever we talk about the reserve requirement stroke the compulsory deposit, we basically mean that all the commercial banks must hold a reserve with the central bank of any country. And we're basically saying that when there is inflation or when there is high circulation of money in the economy, what the banks or the government in relation to the central bank basically do is that they increase the compulsory ratio or the reserve requirement to make sure that most of the money are with the CBK. So we need to say that during inflation, the government through the CBK or the central bank of any country will increase the reserve stroke what you call the compulsory ratio, compulsory deposit, not ratio but compulsory deposit to ensure there is no high circulation. There's no high circulation of money to the public. There's no high circulation of money to the public. There's basically no high circulation of money to the public. And there's no high circulation of money to the public. There's no high circulation. And lastly, we can talk about what we call selective credit control. Selective credit control. One of the reasons why we have inflation being high is that when there's a lot of money in circulation, when there's credit available to all sectors of the economy, then you know that can lead to inflation because there will be money all over. There will definitely be money all over, and that leads to what you call inflation. But basically, during inflation, the government through the CBK will do what you call selective credit control, where credit will only be given to a selective sector of an economy, to a selective sector of economy. And that will be basically a productive sector. We can talk about productive only to a productive sector. We can talk about a productive sector. So when that happens, when you have the credit being selectively given only to a productive sector, this reduces, we'll say that this controls the inflation. This controls the inflation, stroke circulation, stroke high circulation of money, circulation of money to the public, that basically controls circulation of money to the public. And lastly, as an additional, as a bonus one, just to understand this deeper, we can talk about what we call the cash ratio. I just explained it, cash ratio. So we know that particularly when there is high circulation, of money in the economy, what basically the CBK, the government through the CBK does is that they increase the cash ratio. That will reduce circulation of money. And hence, by doing that, they reduce inflation. But again, also of essence, of importance is to understand that questions will not only be touching on this. We can have questions that will basically touch on even fiscal policy. So it's important to understand what a fiscal policy is altogether. Apart from the monetary, it is also very important to understand what we basically mean by a fiscal policy. That is how we particularly handle that question. We'll pick it on the last question. That is last question, April 2024, economics, the last question, that is 7 Roman D. Outline 3 measures that developing countries might use to promote agricultural production. Outline, that is D. Outline what we call 3 measures that developing what we call developing countries might use to promote agricultural production, So when you talk about this particular question, again, it's also more of a general question. When you talk about factors that foster or promote or encourage agricultural production, we know that the basis, one of the major backbone of an economy in this developing country is agriculture. Still, majority lies on agriculture, not much of the industrialization. So again, I say that this is a very much open question. When you ask such a question, we can say one of it is reduce taxes on agricultural, reduces the taxes on agricultural input. So you make agricultural input, and this encourages production. Then you say adopting an irrigation scheme, adopting irrigation schemes to overcome adverse weather condition like drought, to basically overcome adverse weather conditions, adoption of irrigation scheme to overcome what you call adverse weather conditions. And you can talk about developing infrastructure, what you call developing infrastructures in the developing countries. I explain particularly this. Why is infrastructure very important? Some of the challenges and why we have not spurred agricultural production in developing countries because of infrastructure. You find the roads, particularly the roads from the industry to the markets, are not very poor. So with that, there are delays in terms of exportation and that. So when you develop infrastructure, that in turn promotes what you call agricultural production. But I say that this is more of a general question. We can talk about a number of things. We talk about investing in research so that you can come up with better quality of products, investing in research. Again, we can also give loans to entrepreneurs, loans to entrepreneurs for those that actually wants to engage in farming massively. The government can offer loans to such. But again, also research is also very important into coming up with better qualities of products in order to invest in. That is how we particularly touch on that very question. That is question 7D, and that marks the end of that paper. Goodbye. We see one another in the next session.
Now, you can look at a similar question, the previous question. You can look at a previous question. It's been tested just a few semesters back. Let's go to September 2021. September 2021. September 2021. Question who? 5B. September 2021. Question 5B. The question is saying the standard cost of certain chemical mixture is 40% material A at 20 per kg, 60% material B at 30 per kg. The standard loss of 10% is expected during production. During the month of July, the actual data was as follows. Material A used 90 kgs at a cost of 18 per kg. Material B used 110 kgs at a cost of 34. The weight produced was 182 kgs of good production. Let's start by getting our material mix, our material price variance. Our material price variance, you say it is your actual quantity, standard price minus actual price, Your actual quantity, you have two types of materials, A and who? B. The actual quantity you purchased was 90 kgs. The standard price per kg was 20 minus an actual price of 18. For material B, your actual quantity was 110. Standard price per kg was 30 and your actual price per kg was 34. 30 minus 34. This must be 180. That must be 400 and what? 40. The standard or the material price variance here for A, you had budgeted to buy at 20, but instead of buying at 20, you bought at what? 18. So that's good. So that is what? Favorable. B, you had budgeted to buy at 30, ended up buying at 34. So that is also what? That is adverse because you've spent an extra amount. Then you confirm what kind of variance this is, and this is 250, which is what? Adverse. 260, which is adverse. That is your material price variance. Let's get our material mix variance. And how do you get your material mix variance? You say it is your standard price, your actual quantity in standard mix minus your actual quantity in actual mix. Standard price, actual quantity in standard mix minus actual quantity in actual mix. And actual is standard price B. The standard price of A is 20, B is 30. Your actual quantity that was used is 90 for A and 110 for B. Your standard mix, the ratio of how you are using your materials is 40:60. That is 200. that is 100. Therefore, actual quantity in standard mix. You simply share the actual quantity using the ratio of your standard mix, using the ratio of your standard mix. And how will that be? This will be 40 over 100 times 200, 60 over 100 times 200. That is 80, and that is what? 120. All right. Your actual quantity in actual mix we said is your actual quantity. So let's get your material mix variance here. Your standard price is 20. Actual quantity in standard mix is 80 minus an actual quantity of 90, 100. Standard price of 30. Actual quantity in standard mix of 120. Actual quantity in actual mix of 110. This will be adverse, favorable. So that in total, that will be 100 favorable. Okay. The next item they are asking us to determine is your material yield what? Variance. Material yield variance. You said, how do you get that? You simply take your standard material cost per unit into bracket your standard yield minus your actual yield. Standard yield minus actual yield. Let's determine our standard material cost per unit. They were saying there that the standard cost of material of a certain chemical, 40% of material B was bought at 20, 60% of material B was bought at 30. So therefore, your material cost per unit, you're going to take those percentages times the price of each. Which will be 26. That should give you 26. Let's determine our standard yield. Then now need to determine our standard yield. Now they were saying the standard cost of a certain chemical mixture is 40 and 60, and a standard loss of how much? 10% is expected during what? Production. Okay. So this is what we do here. We first identify the input materials that were introduced and the output that was done what? Produced. Okay. And here with an 100% input of materials, with an 100% input of materials, your output was 90%. Your output was what? 90%. Why? Because of a standard loss of 10%. 10%. Okay. If you introduce 200, this can ignore this percentage here, that way. If you introduce 200, how much should have been your standard yield there? Your standard yield should have been 180 units. If you are to use the material in the same way you are using according to what you budgeted, you should have produced 180 units. So your yield variance will be 26, 180 minus an actual yield of 182. Your actual yield is 182. This is 52, which we are going to say is what? This is an output. This is output. So yield means output. So we are going to say it is what? Favorable. Favorable. Okay. Your material usage variance, it's going to be your material mix variance plus your material yield variance. Plus your material yield variance. Your mix variance is 100 favorable. Your yield variance is 52 favorable. So that is 162 what? Favorable. Let's determine our material cost variance, which is your material price plus your material usage variance. Your price variance is 260 adverse plus 162 what? Favorable. Which means that is 98 what? Adverse. 98 adverse. And that is how you determine your what? Your advanced variances of who? Of material. Those are the advanced variances of what? Material. All right.